The ESCoE Director for Research, former OECD, and I'd like to welcome everyone to this webinar. It's a pleasure to have you and talk here about productivity, a topic that is really topical in the UK these days. It is work that is being carried out by Russell Black, Rebecca Riley, and Gary Young. And I have the pleasure of introducing one of the authors here who is presenting the paper, namely Russell Black. Russell is a PhD student at King's Business School and ESCoE. He's also an economic researcher at the UK Department for Business and Trade. His presentation will be followed by a discussant by Professor Raquel Ortega-Argiles, who is director of the Productivity Lab at the Productivity Institute in Manchester, where she's also professor of regional economic development. The format of this seminar is the usual one that we adopt. I will ask Russell to present for about 40 minutes. Raquel will then come in with 10 minutes of comments, which will leave roughly 10 minutes for overall Q&A for the webinar participants. So we are planning to have this event for 1 hour. I should remind everyone that the webinar is being recorded, so that you know this is on record. And without much further ado, I will pass the floor to Russell to ask him to come in with his presentation. Please, over to you, Russell.
Thank you very much all for coming. So I'm going to talk today about attempts to decompose the contributions to productivity growth in the UK and see if this can shed light into reasons why the UK's trend productivity growth is lower. With my co-authors Rebecca and Gary, and the very important disclaimer at the bottom that this is not the ONS, this is not the Department of Business and Trade, this is solely the authors' views, etc. So productivity growth has slowed everywhere. Most countries are in the wrong side of the 45-degree line here, with growth that is slower post-2010 than pre-2010. The UK is further away from the 45-degree line than quite a lot of countries. The slowdown in productivity is pretty bad. So to start with, it's probably a useful country to look at where we have a sharp fall in productivity growth to see what are the causes or what are the correlations and evidence that we can start to use to address the question. We also see globally a decline in business dynamism. This is business dynamism in the UK. This is total job creation and total job destruction from the ONS. And coinciding with the fall in productivity, we also have a fall in literal number of companies that are adding jobs and number of companies that are destroying jobs. In fact, it's the job destruction that's fallen faster than the job creation. So we also want to look at, are these things related? How much of the job destruction is happening? This is job destruction that is weighted towards lower productivity jobs, while high productivity jobs survive or high productivity jobs get created. Linking dynamism and productivity is a massive topic in economics, and particularly Aggregate and Attes, as well as many others, do specifically link this is their structural model of the decline in US productivity growth and the decline in dynamism as a contributor to that. The OECD multi-prod project and the CompNet project in the University of Halle. Beyond the et al. Paper is the latest one from that. Attempts to look at the decline in business dynamism and relate it to productivity growth for a large set of companies. And Decker et al. Is the US Census Bureau researchers on this question in the US. So we're trying to look at the decline in productivity growth and the relationship to dynamism for the UK. We will do this by trying to find data to fill in an aggregate productivity decomposition, where we find a decomposition formula that says this is the total change in productivity growth, and this is the total change in productivity growth that is due to dynamism related factors, and the total change in productivity growth that is due to within firm factors. How much of our productivity growth is because the same firms that existed 10 years ago still exist, and they still are the same size, the structure of the economy is still the same, but everyone is a slight bit more productive in their jobs. How much of productivity is from dynamism? We have changed the structure of the economy. We have a different set of companies that are different sizes. We have smaller companies that are good, that have now grown, expanded, and through changing the structure of the set of companies, the composition has changed, and the changing composition itself has accounted for productivity growth. There are many different formulae you can use and attempts you can do to do decompositions that answer that question. These are a large number of the papers, and we will show you the results using at least some of these formulae. The two wider motivation and bullet points at the bottom, it's a useful exercise in just using commonly used UK microdata sources and to show how these can be used and how good they are for use of different questions. We'll talk a bit about that. And it's also possibly of general interest to see, okay, you have a quantity that you want to decompose into something using a survey source. This is an exercise in that. We have taken a very large random sample of businesses and tried to say, is this large random sample of businesses capable of answering this question? Can we decompose a change in an aggregate according to a decomposition formula that looks at changes in composition and changes in within unit growth? How would you carry out that exercise? This is an example if you wanted to look at that exercise for something that's not productivity growth. What is the decomposition formula? This is just the simple decomposition formula. We have total productivity, total average productivity, which is capital Pi, and that's decomposed into 4 different contributions. So the first contribution is a within unit contribution, where we take the individual change in productivity, delta lowercase pi, and the individual changes in unit productivity are weighted by a sensible number, the share of that company's workers in the economy. That's the how much is productivity growth going because an individual unit is increasing its productivity over time. Then the other factors are the changes in the composition of the economy and how the composition changes feed through. So how much aggregate productivity grows because there is a change in how large existing companies are, weighted by a sensible number, which is the average of productivity levels. And then how much extra productivity is accounted for by adding in new companies and taking away old companies. Are we taking away lower productivity old companies, which benefits the economy because it increases the average productivity? And are we adding in good new productivity companies because their productivity is higher than existing companies? Most of the decomposition formulae are variations of this. This is from Gulishev's Regev 1994. You can use the decomposition from Foster, Holtwang, and Grizan, which is more or less the same. They break out an extra cross term, which represents the extent to which the fastest growing productivity companies are also growing in size. And this is used in many different papers. Decomposition from Dewar and Fox rearranges the terms. The algebra still works here, but it assesses how much the entrants are contributing and how much the X's are contributing relative to contemporaneous benchmark rather than the benchmark from the Grealish and Regev formula. Another formula that's used in this area quite widely, Malletz and Polonek, which is following on from Dewar and Fox, as well as Ollie and Pakes, which is one of the most cited papers in economics. This one is set up slightly differently because it does not use, it decomposes the change in aggregate productivity into two aggregates. So it doesn't use the information of the within unit change. It decomposes the static one period firm weighted one period average productivity with the static one period average productivity in the later period. This is the between effect from this formula is using the relationship between size and productivity. So if there is a change in the relationship between how the correlation between how big a company is and how productive it is, that's how the composition change feeds in. So this is good in a way because you need less information, but it's also abstracting over some of the information that the other decomposition formulae use. So there's no effect. There's no way that there's information that we get from looking at this one particular company changing over time, which is included in the weighting of the other formulae, is summed over for this formula. We'll show the differences between how these formula apply to our data. The data is the UK's annual business survey, which is an ONS data set which is used for the national accounts and a variety of economic statistics. It's misnamed. It's a census and a survey. It intends to be a census of the 20,000 largest businesses and then a stratified random sample of small and medium businesses smaller than that. For this exercise, we're going to take small-ish businesses. So if you're less than 10 workers, you're excluded. And we're also going to focus on the core non-financial business economy, which is the industry sections listed there, which is manufacturing, construction, and most services, but not services where there's a high public sector presence or a high non-market presence. So no health and education, and no arts and other services. This is all nominal nominal data. So we are applying deflators at an industry level, taken from the national accounts, which is another area of significant interest in the literature. But in this presentation, I think we're not going to go into that. We can have talk about it in the discussion later. And different outlier forces are placed in this data. So if you have an outlier growth rate, often that is caused by there being some sort of administrative change or some sort of change in the business register that is not representative. And same, there are maybe data collection reasons why there are specific outlier changes in labor productivity, or explanations why a labor productivity level is particularly high if we don't have good data on the employment of a company. Or the data on the employment is inconsistent with the data on the output of a company. We'll show you the effects of the outlier filters as well. We have this survey. Unfortunately, we don't have this survey balanced. So we don't have a random sample of businesses in 1 year and then those same businesses the next year. So we have the survey weights of how much each unit in the survey represents in the total economy, but we're going to have to recalculate these. So we calculate new transition sample weights, which is following the bullet points here, which I'm not going to read out. But rather than weight up to the total population of businesses, we're going to weight up to the total population of businesses for a transition between 1 year and the next. So we're going to separate out all the businesses between, are you a continua, are you an entrant or an exitor? And then we're going to take all of the data that we have in our sample of exiters, and we're going to reweight them so that they're representative of all of the exiters. And we're going to take all of our companies that we can find in our sample that are entrants, and we're going to give them new weights so that the companies in our sample that are entrants are representative of the population of entrants. And for the companies that are continuers, where we know we have data on them continuing, we have a data point at the beginning and we have a data point at the end, we're going to use those to represent the mass of continuing companies in the economy. We do have data from the Interdepartmental Business Register on exactly what those populations are that we're weighting up to. So you can do this at whatever detail we'd like to. But that's the process. To show you what this looks like, so the UK economy is about 30 million workers. Of those that work in the non-financial business sector, about 20 to 25 million. Of those that we're taking in this exercise, around 12 to 15 million. So we're not taking all the people who are working in companies that are 1 to 9 workers, which is the amount here. And we're not taking the non-core industries. We're taking manufacturing, construction, and most services. So already we're not going to talk about some of the causes of growth because we're just focusing on only these 12 to 15 million workers out of the total. Why are we doing this? We don't actually have enough sample. We don't have enough companies that are 1 to 9 workers to accurately weight up to the population. So at least if we focus on companies that are 10 plus workers, the population of that is only around 250,000 companies. And then there are another 2 million companies which are small micro businesses. We don't have enough in our sample of 50,000 to find continuers that are able to weight up to this population of 2 million. We only have a small number of micro companies that we can find data of. You've got this data point before, and you've also got this data point in the next period to look at their within company growth. This is the total number of respondents per year that fulfill our criteria of 10 plus workers and in the core industries. So the total number of data points available to us ranges from about 30,000 to 20,000, except we can only take them if they are either an entrant or an exitor, or we have data on them continuing. So to have data on them continuing, we need to find data from a period before and also a period after. So this does limit the amount of the 30,000 data points that we can use. So if we want to know, if we're looking at a 6-year interval, we need to know either you are an entrant within these 6 years, or you're an exitor within these 6 years, or you're a continuer within these 6 years where we have data on you in year T and year T minus 6. So for 2005, we would need to have data on you as a continuer both in 2005 and also in 1999. So we have around 27,000 businesses we have data on in 2005, but to have data on in 2005 and also have data on them in 1999, we do not have 27,000 businesses. We only have around 14,000 businesses. So we have to get rid of 10,000 data points because we don't know what this company was doing in 1999. So we're giving these companies new weights. These new weights will be about twice as large as the weights that we were giving them previously. We're still weighting up to the same number of companies, but we have fewer data points to do the weighting upwards to. This is the symmetric graph, but this is now in 1999 looking forwards of the number of companies we have in 1999 where we have data on them in 2005. So it's not ideal to be using a small number of data points and having each of these data points being used more intensively. So now each respondent we have has to account for twice as many businesses in the total population than it once was. So the dotted line here, the dashed line here is the full sample, about the 30,000 businesses per year. And then the single lines are each transition year sample for the 1 year transitions. So this is where we have a business where we know either you're an entrant or an exitor in the 1 year interval, or we have data for you both at the beginning of this interval and at the end of this interval. So this plots our estimates of average productivity from this data. For the transition for example, from 2005 to 2006, in this transition sample, we estimate productivity at whatever these two numbers are here. And this is different because we're using a different set of companies, a different set of weights to if we're using the full sample, and mostly it fits. So certainly for some years we have a growth rate in our transition samples that's very similar to the growth rates in our full samples. For some years it's not quite so good. So for 2000 to 2001, actually, if we use the companies where we have data from 2000 to 2001 and weight that up, actually that's falling, where we're pretty sure the truth is it's growing. And if we use the full sample is growing. And in the 2010s, there's a small amount of bias here because the companies where we have data on the year before and the year after, those companies seem to be structurally a bit higher productivity than the rest of the sample. What is the solution to this? We're not going to use any individual year sample too heavily. I don't think we can do that. Instead, we'll divide the time series up into different periods, and then we'll take the average. So an average of some that are falling, some that are increasing, some that are increasing faster, some that are falling slower. And we'll show you if this is a reasonable attempt or not. While we do have a higher level in the 2010s, it's relatively consistently higher. So at least the main economic trajectory is growing, then stagnant. Both samples, either the sets of transition samples averaged or the full sample, still match this narrative of growing and then stagnant, even if it's stagnant at a slightly higher level than we'd have liked. This is the 1 year transition samples. This is the 6 year transition samples. So our before number will be the average of these 4 different 6 year intervals. And our post-crisis number will be the average of these 4 different roughly stagnations, even though one of them is growing, one of them is shrinking, or 2 of them are shrinking. This is the table showing, is this a good assumption or not? So the national accounts productivity fall is around 1.5 percentage points. If we use our transition samples, it's either 1.5 percentage points or about 1.7, 1.6 percentage points. So this is roughly the best that we can do with the data and with the requirements to get data on and track the companies before and after. Other things to note about the data, entry is falling over time. We have a lot of exiters before 2010, a lot of dynamism. This is a counterpart to the job creation, job destruction graph. In 2005, fully 15% of workers are in companies that are exiting, if it's exit over a 6-year interval. So entrants and exiters are low productivity. So this is over a 6-year interval. Even if we take all the companies that have entered over the last 6 years, they still have not grown to be as high productivity as the existing set of companies. Exiters are also lower productivity. If you're exiting, you're exiting because you are less productive, profitable and productive on average. So these are the results. And I'll linger on this slide and I'll probably go through the rest of the results a bit more quickly because most of the results basically follow this pattern. This is the most important slide. So we're using the D8-Fox decomposition for this slide. And this slide breaks down the terms that I started showing you into how much they're contributing each of the 6-year intervals. So starting in the middle with the between growth, this is the one where it was high and then it's low, and where it is responsible for the productivity, responsible for about half of the productivity slowdown. We have clear 6-year intervals where at the beginning of the 6-year interval and at the end of the 6-year interval, a lot of the productivity growth is caused or is due to arithmetically the fact that there are different companies that have different shares of total workforce, and more of the shares of the total workforce are in higher productivity companies than used to be the case 6 years before. The period ending in 2008, actually, that's not the case. Sorry, in 2004, that's not the case. Whereas the period ending in 2006, it's very strongly the case. But overall, if you were to average this, it's positive. Within is a bit bouncier. So we have one 6-year sample ending in 2004, where it's 0, then another where it's half, then 2 years later, 2%. It's a bit more volatile. And the 6 years between 2009 and 2015 have very strong within productivity growth because they're starting at quite a low base in 2009. Similarly, the 6 years in 2014 to 2020 are ending in a period in 2020 where their productivity is much lower. Both of the crises are very strongly within company crises, at least from this data in this exercise. Sorry. Versus the continuous, entry is not that interesting a story. There aren't enough entrants, and the entrants and exiters are not high enough productivity to move the dial. So entry is consistently negatively contributing. If we take over a 6-year interval, 6 years, even 6 years is not enough for the entrants to grow and on average contribute higher. And exiters, if you're exiting, it's always good for productivity because exiting means you're a low productivity company. But that has not changed really over the time period. We are not disciplining by exiting companies out of the set of companies any much more effectively than what we used to as a proportion of the total productivity. And exiters are already low productivity and already a minority of the economy. The action that is taking place amongst the existing set of large continuers is doing more to drive productivity growth. This is largely repeated across the decomposition formulae, the 4 that I showed you. The Melitz-Polonek formula, this uses an average that is weighted by firms rather than weighted by workforce share of firms for the within effect. So it's basically, it's a within effect, but the within effect counting every firm with the same weight. So a firm that has 40 workers would have the same weight as Tesco. It seems like more of the effect from within productivity growth is being driven by larger companies, which is accounted for because Tesco is given the weight of Tesco in the workforce in the three other decompositions, and that's what is determining the lower within growth at the beginning and the larger between growth to compensate. These are the averages over the periods. Well, if we take the 1999 and minus the 2011 to get what are the different factors causing different growths, you get this table here. And this is the key column. So of the approximately 1.6 percentage points average fall in productivity growth from the averages across all of our samples, it's around equal split between the falling within component and the falling reallocation component, although the within component, as we saw, had a bit more volatility. The between component was a bit more stable across the different samples. The 5-year interval and the 6-year interval give us slightly different numbers as well. In the 6-year interval, the external factors, which is the between factor and the net entry, if we wanted to add them together, almost 2/3 versus 30% to 40%, almost a third. I'm actually not sure why that is. This is exactly the same data. It is exactly the same code. I think it would be nice if we had a larger sample size, and if we had a larger sample size, these would probably converge to both factors being around equal. So what we can say is, in one estimate, we get 60%. In one estimate, we get 34%, 39% of how important is dynamism to productivity growth, which is the overarching question. I think it's still both sides are substantial, approximately equal, but still a range of answers. And this is the third and the fourth bullet points of the motivation of the paper of examining how useful this data source is. This is our answer. So very useful, but still not completely precise, I think, judging by this table. The rest of the results I'll go through quite quickly, and then we'll get on to the discussion and questions. This is the table presented in bars, if this is a nicer way of presenting this. So you can see across the 4 decompositions, this is the existing growth, the post-crisis growth, and then the change. So about 1.5 percentage points, adding up the between and the within effects, and relatively little growth due to the different entry effects. Does this change if we use different outlier methods? No, not really. If we use stricter outlier filters, or if we use more generous outlier filters, this makes relatively little difference. Again, does this change if we use different weighting methods? Not really as well. If we didn't use any weighting at all, we'd get very, very different numbers. But if we vary how we carry out the weighting, if we use different weighting strata that are either narrower or wider, this also generally does not affect the picture. Either there is you can get a small amount of change, but most of the magnitudes are roughly half-half. The strictest to the least strict still gives you around 2 percentage points. So again, it's very useful and gives you an indication, but not to a massive degree of precision. I think it's useful to see this graph to see how much you can vary the numbers just by this particular data choice in the data cleaning process. Ultimately, the main narrative of both factors are important. Goes through. Finally, which industries are responsible? We can show you this at least. So this is the total number of workers in each industry, and the core industries that we're taking are the 4 bottom ones here. Sorry. So manufacturing, construction, and services. Services are split into industry sections GHI and industry sections JLMN. GHI is retail, transport, and hospitality. And JLMN is information technology and professional services. The key change in the UK workforce since 1989 is a fall in the manufacturing sector. Manufacturing goes from around 4 million jobs to around 2.5 million jobs. If we took this graph back in time, the manufacturing would be much bigger. Manufacturing in the UK fell as an employment share very substantially in the 20th century, from its peak in about 1950. What's remarkable is that it still kept falling even into the 2000s. So in 2000, you have China joining the World Trade Organization and the further integration of Eastern Europe into supply chains. That really did take a toll on the UK manufacturing sector. So the UK manufacturing sector is substantially smaller and substantially fewer workers. The entire workforce has expanded greatly, though, because the services have ramped up massively since. So we'll be able to see this in the decompositions. So this is the 6-year Dewitt and Fox decompositions I showed you before. Within firm growth was very, very high for the particular years after 2000, and this is the fall in the manufacturing sector workforce. But the fall in the manufacturing workforce has been very good. So lots of large manufacturing companies increased their productivity substantially, and they did it within company. So there's a positive platoon effect, but there really is a very large effect from shrinking their own workforces and automating or integrating better with external supply chains or a complementary combination of the two of them. And that's the main factor that was driving within growth within firm growth before 2009. The within firm growth from services is there, but it's not happening particularly fast, and it's not happening a particularly strong amount of magnitude. Manufacturing is still a minority of the economy. Even as a minority of the economy, it is doing the vast majority of the within firm growth. And actually, in places like retail and hospitality, there is no within firm growth. There is the only productivity growth that is happening among supermarkets is reallocation between supermarkets. The supermarkets themselves are, if anything, shrinking in productivity between 1999 and 2005. This is just to show you those results in a table. So there's a substantial amount of the productivity growth that is accounted for by less reallocation among services, but also manufacturing growth is because there was a large reservoir of lower productivity manufacturing workers at these different companies that could be moved into the rest of the economy. It's not surprising that manufacturing does not have any more within firm growth. The manufacturing share of the economy is now share of the workforce is stabilized quite noticeably at 2.5 million and not really gone below that since 2010. So the manufacturing sector growth now is more normal than the growth that it had before 2008. There's a manufacturing specific story, not just the entire economy having lower dynamism. So thank you for listening. I guess our bullet point conclusions will be this. So the headline is approximately equal. Effects from lower within firm growth and lower growth that is associated with dynamism, because we can see there is growth because these companies that are high productivity are getting larger and the composition change is feeding through. Both of those are lowering product. Both of those account for the fall in trend productivity growth, at least for the industries we're looking at. But the within growth is a one-off. This couldn't be repeated. It's more just noteworthy historically, whereas factors that are leading to the fall in reallocation feel a bit lighter. There's no immediate one-off cause that we can see just by looking at the data and sort of reading and thinking what's happening. The choice of decomposition formula does actually make a difference. So if you only use the Melitz-Pollanek formula, it's worth also looking at other formulae. And we did get a lot of variation. I put approximately equally rather than a more precise number, where the 6-year results shows the fraction at 60%. But the 5-year results should have been a bit more similar to the 6-year results for having more data points. I think we still are suffering because we can only find 20,000 data points where we actually have a before observation and after observation, and we can only use those 20,000 data points to represent the entirety of the before and afters for 200,000 companies. If we had a sample of 40,000 befores and afters, I think we'd do a bit better. If we had a sample of 60,000 befores and afters, we'd do a bit better to represent the 200,000 companies rather than what we have. I will end there. Thank you very much for your time listening, and hand over to Raquel.
Thank you, Russell, for a clear and very interesting presentation. And I immediately turn over to Raquel for her comments.
Thank you very much. Can you confirm that you can see my screen?
Yes, we can see your screen.
Yes, we can.
Okay, thank you very much. So I just made a few comments on the presentation. I haven't had very much time to go through the presentation myself, but just based on the presentation today, I can derive some conclusions. So just as a summary, I think the motivation of the piece is the declining business dynamicity and also the access to this wealth of microdata with detail on entry and exits. The objective of the piece is to analyze if the UK declining business dynamism in the latest decades can be related to the lower trends in productivity growth or the productivity slowdown. I think the methodology focused mainly in calculating this business dynamicity and also the components of the aggregate productivity to evaluate which component has the major contribution in explaining the aggregate productivity trends and the link to business dynamism, and the use of different methodologies to decompose the aggregate productivity microdata to control for the potential sensitivity to the methodology. I found that the interesting conclusions is that the choice of aggregate decomposition formulae makes big differences to the results because each methodology promotes somehow different aspects of the productivity growth. And as Russell was pointing out, I think that careful attention should be paid to the consistency of the data sources and across data sources and how the data is being treated. And also what I found very interesting is that this contribution to different groups of industries to the productivity growth over time, in particular the big differences between manufacturing and services. So my conclusion will be that industrial policy should somehow be aligned to the development of the structural economy and its contribution to productivity over time. A few comments from my side is that I found that actually the motivation of the piece should be extended. You know, as I say, I couldn't have a look at the paper, but I look at the slides, and I found that in the motivation of the piece, all the countries also show this productivity slowdown. And of course, I mean, we are all here very interested in the UK case, but I also feel like we should try to explain more in detail why the UK and why the selection of these time periods and intervals as the conclusions using different intervals are very different. Also, I think Russell has mentioned that previous attempts to perform a similar analysis in the UK have been developed by people such as Patrick Snyder from the Bank of England, using one of the most used methodologies like the ESCoE decomposition. So I think that maybe to relate how this piece relate to what Snyder found in the past, where Snyder was using slightly different data sources and different periods of analysis, will be also interesting for the reader, you know, to understand where this paper sits. I also feel like what I really like it is that the authors, they compare to different methodologies, and I will just like to see which one they finally select. You know, so what is the motivation of the choice of the different methodologies, and also thinking about that some of the authors that put together those methodologies, they seem to fit more for the US rather than for the UK. So what is the possibility of reproducing this analysis to maybe, you know, other data sources? So Russell was talking about the fact that the data source that they are using, maybe when using these intervals, might undermine, you know, maybe the entries because of the number of employees, you know. So you might have, you know, problems on the representativeness of certain industries, or maybe the representativeness of certain places within the UK, so like Northern Ireland or firms with less than 10 employees. So, I mean, in order to be provocative, you know, can we use other data sources, you know, maybe big data for shorter time periods used to contrast, you know, the quality of the data source that is being used. Another thing that I would like to mention is that how assured that the survey is representative across time on the sectors that they are contributing to the economy in different points of time. So Russell was talking about the decline of manufacturing, you know, and maybe the increase of services, or within services, the increase of maybe particular parts of services. So it was talking about business and professional services, and maybe the financial sector that falls within business and professional services. So how do we know that this survey keeps consistent the representativeness of the contributions of those sectors over time, you know? So these are, of course, big questions that we all made ourselves when you use administrative data and data from official data sources. And for me, I think that the robustness checks that I will emphasize is that if I was the reviewer of your piece in a journal, is that there are very interesting conclusions, but all of them somehow are somehow linked to the sensitivity and the bias of the results to, you know, the transition methodology that you impose, you know. So maybe this transition methodology is biased towards the years that you are using, 5 years over 4 years. Maybe also the emphasis that different methodologies for the decomposition put to different components of this decomposition, So maybe that is also a sort of maybe sensitivity that you might want to reduce by just deciding at one point which is the best method for the UK case in that period of analysis, So making a bet of I would like to take that one. And for the end of my contribution is like I'm very interested in the variability within sectors. So maybe can we say more about the variability within services? We have two components of the services, but can we say a bit more about the variability within the manufacturing sectors? How are the contributions? Is there any hope to use somehow support particular industries that they seem to be the ones that they contribute more to our productivity growth over time in the UK in the period of analysis? But all in all, thank you very much for this piece. I really enjoy having a look at it, and I'm sure I'm going to use it with my students in the future. Thank you very much.
Thank you, Raquel, for these comments. Before I open up for some general questions, Russell, do you have any quick reactions to what Raquel just put forward?
Yes, very quickly to save time for questions. So thank you very much. That's all very, very, very useful comments to understand, and we will make sure once the full paper is out that we incorporate all of the differences, and we can talk about more on the differences in our paper and the Schneider paper and other papers in the UK and across jurisdictions. The representativeness, so the national accounts benchmark is adjusted to be accounting for the fact that this is not the national accounts productivity growth. This is not the national accounts productivity puzzle. It's less because it excludes finance. So it's recalculated to be on a consistent basis of what we're looking at from the surveys. On how much has the representativeness changed over time, and how good is it for different industries? Again, it's as much as you can do with about 20,000 data points to cover all of the different regions and all of the different industries. Ironically, Northern Ireland is the best. Northern Ireland's own annual business survey has a much higher density inside Northern Ireland than the ONS's Great Britain level survey. The Great Britain could learn from Northern Ireland there. On terms of which decomposition method, I think we're not going wrong. The Dewitt and Fox and the Greater Regev decompositions, which are broadly similar and show broadly similar results, that's not surprising. I think the strength of them is they do use the within company data weighted up rather than comparing two different within company periods, and putting weight on large companies that is relative to large companies rather than looking at the change between the large company premium, which is effectively what the Mellets and Polonek decomposition does add value. So understanding why the Dewitt and Fox-esque decompositions are different increases your knowledge. But that's the one that we led on in the main graph. The only solution to the not having enough data points problem is to find more data points. So either we give a lot more money to ONS to survey a lot more businesses, or also we incorporate all of the different administrative data that is held on businesses, and that is an active area of research in this wider project that this paper forms one part of. But definitely that is the only way.
Thank you, Russell. Well, that leaves a few minutes for Q&A from the participants of the webinar. If you do have any questions or comments, I would ask you to put them in the Q&A section of the setup. The chat function has been disabled. And I see there is already one question with three sort of three sub-questions. It's probably easiest if I read it out rather than calling on the person in the interest of time. So said that this is a very interesting presentation with three lay questions. One is that whether the use of employment shares as weights have the effect of giving materially greater weight in the aggregate to the contribution of relatively low productivity firms, and if so, what would the decomposition show if the weights were used, if the weights were based on output shares? And secondly, what is the rationale for excluding the banking recession years in the second period? And finally, what would the first chart show if instead of productivity growth rates in the two periods, it plotted output growth and employment growth, as it's been claimed that the UK's unusual experience is due to unusually sustained employment growth after the banking crash. So three questions actually, but three interesting ones. So, Russell, do you have any comments on those?
So question two is taking that as the easiest one. In 2008-9, productivity goes massively down because you have a crisis, and then in 2010 it sort of rebounds in the crisis. So if you average them out, actually you probably get the same, and it'd probably look the same. But the particular sharp fall and the particular sharp rebound are sort of their own stories, and what we care about is the trend post the rebound, which is the massive overarching economic problem of our time. The growth since 2010, as you can see, the UK economy added a lot of workers post 2010, and that's the next part of the productivity trend growth mystery, is why the increase in workers post 2010 was not coming in at the levels of the productivity of the workforce as it stood in 2010. But our answer is too much of the companies that are low productivity companies are absorbing these workers, and it used to be the case that higher productivity companies were able to grow faster than the lower productivity companies. The employment shares, because it's the point is the employment is the denominator, and we're decomposing how something affects a ratio based on the weights of the denominator. By using employment shares as weights, it gives contribution to companies by how many workers they have, whether they're low productivity companies or high productivity companies. It's not promoting the low productivity companies any more than the low productivity companies exist as a share of the workforce. And that's how important the low productivity companies are. If the weights were based on output shares, it would still if you redid all the formulas that was done in output shares, it would still roughly be the same, although output does move across businesses faster than employees move across businesses. Actually, there is still a slowdown in the reallocation of sales across businesses, like there is a slowdown in the creation of workers. So the number of companies that have started that have a much larger sales than they did before has also fallen. So I think, if I had to speculate, so Michael's question, creative destruction, growth of Amazon. So yes, Amazon is incorporated in this. So we should be, if we see, yes, we have a load of new warehouses open, and a warehouse worker is more productive than a shop floor worker, and we see a load of shops closing. That is exactly what you should be seeing from the entry and exit effects, and from the continuous reallocation, the continuous between effect, because maybe the warehouse already existed, but now it's becoming much bigger. And that is one of the reasons. That's one of the reasons why there was strong dynamism before 2010, and I think that would still be contributing to dynamism post 2010. Everyone else is doing bad, even when they're getting this sort of adrenaline shot from Amazon, as Amazon and e-commerce is continuing to grow in the 2010s. But workers moving from warehouses to from retail to warehouses is exactly what this method is tracking. As it happens, actually, the warehouse sector used to be a lot more productive. Now it's been diluted because it's got a lot bigger, and as a bigger stage, actually, it's now doing activities that are on average less productive, even if the total share of the economy is warehouses has increased. Retailing specifically in shops, not retailing taking account of the entire warehouse and retail chain. Warehouses are a separate industry code to retail. Sorry, I made that clear. So the entire e-commerce ecosystem itself. I still don't know if that entire e-commerce net system is net positive or net negative, because it could be that the decline in dynamism just generally of retail shops is also less than what it used to be, just because shops themselves are have less animal spirits or something like that. But at least the effect from e-commerce has been doing some amount to help. And because everyone in the economy is using e-commerce to sell their products, eventually, I think it would be something that's helping everywhere. One of the arguments for why we're seeing declining dynamism is actually this, that if you're a existing company with a strong brand, actually new ability to sell through e-commerce, through digital, through growing importance of intangible capital in that respect, that actually helps you through within growth rather than between growth. And that the technology is more complementarity to within company growth for large companies than it is to dynamism and large companies losing their place.
Very well. Thank you, Russell. The webinar was scheduled for 1 hour. We've already slightly gone over that, but I think it's been worth given the interest in the subject. So let me just conclude by thanking the authors, thanking the presenter, thanking the discussant, and thanking the participants to the seminar for their interest and for coming into the meeting. Lastly, there will be another one, the 30th of January, equally interesting topic, and I do hope to see you all again there too. So have a pleasant afternoon, and thank you so much. Bye-bye.
Thank you all for going. Bye.